Have you ever looked down at your bank balance and asked yourself what it really is? Is it savings or a promise someone else made to accept a number as value? For most of us, money feels solid, a salary, a bank account, a paycheck. But underneath, the modern currency is often an IOU, a promise written in a ledger. This documentary asks a simple question. What happens when promises replace things? When the tools we use to store value are themselves debt instruments, what stops a system from unraveling? Over the next hour, we will trace the accounting behind currency, reveal how IOUs become national money, and show the hidden math that turns confidence into collapse. I'm Dr. Reid, Mind Money Mentor, and this is the story of money turned into promises. When currency is a promise, the system depends on trust. If people trust the promise, credit flows and economies grow. If trust fails, liquidity freezes and the ledger tears. Collapses do not begin with paper. They begin with erosion of trust. Today, trust is fragile in a globalized financial system where accounting rules and political pressures intersect. This film is about that fragile intersection and why the accounting choices made in quiet rooms shape the fortunes of millions. Long before banks, people exchanged goods for goods. Then precious metals replaced barter because coins were portable and scarce. Gold and silver were tangible. They had value because they were scarce and useful. But as trade expanded, carrying metal across continents became risky and inefficient. So merchants began to deposit gold with trusted custodians and accept receipts in exchange. Those receipts promised redemption of the stored metal. Soon people began to use receipts as money. Trade accelerated. The first IOUs were born. They worked until custodians began issuing more receipts than gold in storage. That small leap, issuing promises beyond reserves, is the ancestor of much modern money creation. Ancient Rome provides an early and brutal lesson. At first, Roman denarii carried silver. Over time, emperors diluted the metal to fund wars and luxuries. Coins were mixed with cheaper metals while declared at the same value. For a while, people accepted it. For a while, the empire paid its debts. Then, value unraveled. Prices rose, trust collapsed, commerce contracted. Rome's economy sagged before its political power did. Debasement shows the fundamental risk. When a state controls the token of value, it can overissue promises until the public refuses them. In medieval cities, goldsmiths acted as safekeepers for merchants' metal. They issued receipts for deposits. Those receipts became tradable tokens. Goldsmiths realized that not all depositors would redeem simultaneously. They began to lend the idle gold as loans, charging interest on the promise to repay. The goldsmith multiplied the economy by converting stored value into active credit. But that multiplication was based on trust and on the assumption demand for redemption would remain staggered. This arrangement formalized fractional reserve practices, a ratio of reserves to outstanding promises. By the 17th century, England needed a new funding mechanism for war. The Bank of England emerged as a public-private solution. Government would borrow, the bank would issue notes, and the public would accept the notes as money. This institutionalized IOUs at national scale. Banknotes were promises to pay in gold, but governments and banks discovered they could issue more claims than bullion backing them. Controlled expansion fueled empire, trade, and industrialization. But the root remained the same: money as an institutional promise, not intrinsic value. Modern money creation hinges on a simple accounting identity. Loans create deposits. When a bank makes a loan, it credits the borrower's account, creating a deposit, new money, out of thin air. That deposit becomes part of the money supply. This is how commercial banks expand currency beyond central banknotes and physical cash. But each loan carries interest, a future obligation larger than the principal. This system requires more money tomorrow than exists today to satisfy principal plus interest. This arithmetic drives the need for continuous credit expansion. Most banks hold a fraction of deposits as reserves and lend the rest. If the reserve ratio is 10%, a single deposit can support many times that amount in new credit through successive lending rounds. This is how modest savings turn into large credit expansions. It benefits growth in normal times, but it creates fragility. If depositors lose confidence and demand withdrawal simultaneously, banks can't honor all claims. That is a bank run. Modern regulation, insurance, and lender of the last resort functions mitigate runs, until the system's scale makes mitigation politically and financially costly. Interest is central to the IOU economy. It is what makes loans profitable. It is also what guarantees the system must grow. Interest means that total obligations exceed total money in existence if we count only principal. To pay interest, new loans must be made. To make loans, new money must be created. This is why economies chase growth. Growth creates the income streams that allow interest payments. But growth has limits: ecological, demographic, and political. When growth slows, interest obligations persist and stress rises. When governments borrow, they issue bonds, IOUs backed by the expectation of future tax revenue. Central banks can buy these bonds, creating currency in the process. This becomes a loop. Governments issue debt to spend, central banks buy debt to keep rates low, spending continues. This coordination can stabilize a recession or enable prolonged deficits. Yet heavy reliance on this loop converts national currency into an IOU on top of many IOUs, a stacked promise structure more fragile than it appears.
When belief in the promise erodes, people demand real value, not paper. They spend quickly to avoid losing purchasing power. Price spirals follow. Weimar Germany and Zimbabwe are textbook lessons. Rapid money printing, combined with collapsing output and political disarray, produced hyperinflation. People abandoned the currency for foreign money, barter, or tangible goods. Default becomes rational for rulers under pressure, and the social and political fallout is deep and long-lasting. After World War II, Bretton Woods linked global currencies to the US dollar, which was convertible to gold. This system centralized trust in the dollar. But by 1971, the US ended dollar-gold convertibility. The dollar became a pure IOU of a government led by its fiscal and military power. From that point on, the world's reserve asset was an IOU, and global liquidity rested on faith in American institutions and markets. That faith would be tested repeatedly. Modern finance hides risk in complex places. Shadow banking creates credit outside traditional bank balance sheets. Derivatives layer promises on promises, credit default swaps, collateralized obligations, structured products. They shift risk across parties, often leaving the public sector to backstop failures. When this off-ledger risk becomes systemic, crises appear suddenly, as in 2007 to 2009, when housing IOUs became a global contagion. The 2008 crisis began with mortgage lending and complex securitization. Loans were repackaged, turned into new IOUs, and resold globally. When borrowers defaulted en masse, the supposedly diversified pool of claims failed. Banks and shadow banks held the wrong promises. Confidence collapsed, liquidity froze. Governments intervened with bailouts and central banks with massive asset purchases, creating new currency to stabilize the system. The intervention stopped the immediate collapse, but it did not remove the underlying structure that created the fragility in the first place. In 2020, governments and central banks acted massively to prevent economic collapse during the pandemic. Trillions of newly created currency and guarantees flowed into markets. This prevented immediate disaster, but also enlarged the balance sheet of central banks and the mountain of public and private IOUs. The long-term consequences include asset inflation, wealth concentration, and new pressures on currency legitimacy if growth and productivity don't keep pace. Today, the move towards central bank digital currencies promise efficiency, traceability, and control. CBDCs are not neutral. They are programmable IOUs. The ledger can be coded to expire money, to enforce negative interest, or to restrict transactions. The same IOU architecture that once fit paper and coin will now run on code. This opens efficiency and novel policy options, and it concentrates control. The digital turn may solve some problems, but introduces new forms of fragility and political risk. When a currency collapses, the burden is rarely shared equally. Wage earners and savers lose purchasing power. Those with illiquid assets tied to domestic currency can be ruined. By contrast, those holding foreign currency, hard assets, or credit lines often preserve wealth. The pattern is predictable. Collapses redistribute real wealth towards those with access to alternative stores of value. Currency collapse erodes social trust, increases political extremism, and fuels unrest. Inflation hits the poorest hardest. Social safety nets fray. Political legitimacy declines. History shows that economic crises reshape institutions, sometimes permanently, and often in ways that empower those already close to financial levers. First, understand, most money is an IOU. That knowledge reframes risk. Second, diversify stores of value. Avoid concentration in domestic cash only. Consider tangible assets, foreign currency exposure, and real productive assets. Third, improve financial literacy. Learn the accounting behind policy decisions. The more you know, the less you are surprised. Fourth, push for transparency. Demand better public accounting and clear rules for central bank actions. Money is trust, and trust can be engineered or eroded. When currency becomes IOUs, accounting choices become political power. Know that the system rewards those with access to credit and penalizes those relying on fixed cash. If you value stability, pressure institutions for clear rules and safeguards. If you value personal resilience, diversify and understand. This is not fatalism, this is clarity. With knowledge, you can protect value and act when policies change. I'm Dr. Reid, Mind Money Mentor. If this film helped you see money differently, subscribe, share, and continue the conversation below. Knowledge is the first defense against systems built on promises.